Okay, welcome back to Self-Managed 360. Before we get into valuation of companies, because we want to invest in companies that are profitable, that are in solid financial health, but we also don't want to pay too much to own them. Uh, so we'll talk about valuation of a company using ratios. Before we go into talking about the valuation of a company using ratios, we need to talk about some really useful ratios that are often used by financial analysts or that you will find often on financial websites. Uh, these ratios are often linked to the level of profit that the company is making and to the price the stock is currently selling. So information that you will find on financial websites, basically on every single financial website, you'll find the stock price of a company. So as we've said previously, the stock price is set by the latest transaction that has been completed. The buyer decides to buy shares at, for example, $10, means that the seller has agreed to sell him his share or some of his shares at $10. So the stock price is driven by the market and is related to the latest transactions that happened the same day, the same week, whatever. Another ratio that, well, this is the stock price, it's not a ratio, it's the stock price. Then one of the ratio you will see is the EPS, earning per share. So in that case, let's say we have $0.5 per share. So we'll see how that is calculated shortly. And you will also hear and read about the price to earnings, or PE. In our case, I put 20 just for to explain a little bit how it can be shown on financial websites. So let's discuss first the EPS, earnings per share. So how do you obtain the EPS? Well, you divide the net income. So basically, the latest net income from the latest annual report. So net income, we find it in the income statement. It's the net profit of the company. So you use the net income and you divide it by the outstanding shares trading. So how much shares are actually available on the market. So that will provide a very useful value to investors. It's going to give you how much of the net profit is allocated to one share of the company. So it's good to see or hear that the company, for example, is making a net profit of $1 million, but how much of the profit is allocated to owning a share. For example, if you purchase a share of a company that is generating a net profit of $1 million, and you know that they have 2 million shares outstanding, that means that 50 cents will be allocated of the net profit will be allocated to the share that you want to purchase. So it's important to know how much of the profit is allocated to the shares you want to purchase or that you actually own or you may want to sell. Um, the EPS, it's fun to know how to calculate it. Again, it's the net income divided by the outstanding shares, but it's always provided on the financial websites. It's a key value, it's a key ratio, so you may never have to calculate it. It's going to be provided to you. The other ratio that we will look at, the price to earnings. So basically how to calculate the price to earnings or the PE. You have to divide the market price of one share, so basically the quote on the stock today. You use that value and you divide it by the EPS. So we're just talking about the EPS. That's going to give you how much you pay to own the profits allocated to one share. So if a company has an earning per share of 50 cents, as we can see here, let's say it's generating a profit of $1 million. It has 2 million shares outstanding, so the EPS is 1 million divided by 2 million, so you end up with 0.5, 50 cents per share of profit. And the current stock price, that is, the shares are currently trading at $10 per share. So you divide 10 by 0.5, you end up with 20. The 20 is how much you pay to own the profits associated with one share. So you pay $20 for each dollar of profit that company is generating. Those two are the most important ratios. There are others. There are actually so many that we will not discuss them all, but you will also find a ratio called the price to book value. So the price to book value is the market price. Again, which price the stock is currently selling, and you divide it by the shareholders' equity, which is the book value of a company, and then you divide it again, or you divide the shareholders' equity by the quantity of shares trading, so the outstanding shares. You can also, if you want, calculate how much cash the company is generating per share, so you divide the cash flow per year, the net cash flow by the outstanding shares. Or you want to know how much you paid for the revenue, so price of sales, revenue, same word, different word, the same metric. So you divide the price of the company, so in your case 10, you would divide it by the revenues, and and that would give you, sales. It's always price to sales, it's always revenues to outstanding shares, right? Or you want to replace EPS, earnings per share, by you divide the value of the stock, you divide it by the earnings before taxes, as we discussed in our video on the income statement. Some people prefer to use the operating profit before taxes, so you would do the same thing. You would first calculate the operating profit per share, and then you would divide the market value by this value. There's so many others, but I think right now what we want to do is concentrate on the EPS and the price per earnings. So, as I said, the most important ones we will consider, and this is for valuation reasons, that's going to be used to assess the value of the company. We need to understand earnings per share and price to earnings. What will influence the EPS? Well, the quantity of outstanding shares trading on the market. Sorry about that. And new shares issued. So if a company is issuing new shares to finance its activities, and it's not making more profit, obviously it's going to dilute the EPS. That can be seen as a bad thing, that can be seen as a good thing. It depends on the situation and the reason why a company is issuing new shares. But obviously, EPS will be impacted if a company decides to issue new shares, or if it decides to purchase back shares. If it wants to reduce the quantity of shares outstanding, it may decide to purchase its own stock. Then that's going to have a positive impact on the EPS. Obviously, the profit net income level. If the EPS is positive, it means that the company is making a net income that is positive. It's making a profit. If the EPS is negative, the company is making a loss. So if the profit is increasing every year and the outstanding shares are stable, we should see an increase in the EPS. So what we want to invest in are companies that are increasing the EPS. We'll understand why later. Increasing EPS means that you buy a share today, you're paying a certain amount to own the profits allocated to each share. So you're paying for the EPS. If the EPS is growing, the earnings per share is growing, that means that the profit allocated to each share you own is increasing, which is obviously a good thing. We want to see our profit increase in time. That's obvious. Then what will influence the PE, the price per earnings? Well, obviously, the growth potential and expectations. So if a company has a high growth potential, some people may want to pay more for the EPS. So they may want to pay more for the EPS, so the price per earning will be higher than for a stock for which people are ready to pay less for the EPS, earning per share. Industry it operates in. Industrial stocks may have a lower price to earnings than high-tech companies, for example. It will depend on the industry the company is operating in. The hype and the sentiment of the market. As we said in our first video, or first two videos on stock market investing, obviously we don't want to invest in hype, but when we want to purchase a stock, for example, today, we are buying today on the price that is given to a company, to a stock by investors, and the price given is because of the hype, the sentiment, and the emotion of the people that have been trading the stock today and yesterday. So we need to understand that when we're getting involved in investing in stock, yes, we want to own it long term, but we still have to deal with the hype and sentiment of the current situation, which is when we want to complete our transaction. So if the company is really popular, you may have more demand than supply. That could push the price per earnings up, which is not necessarily bad. Well, it's not good to pay more, but it may be justified sometimes. So we will try to invest in companies that are valued according to market or to its peers, ideally less than market and less than its peers, so that we will get a fair or discounted price to own shares of the company. And as we've said, we don't really want to pay more than 20 to 25 times the profits per share. So if a company is making an EPS of $1 of profit per share, you don't want to pay 40. You may have to sometimes if there's a company that's really, really interesting with a huge amount of potential. But ideally, you want to keep the average of your portfolio around 20, maybe 22, so that you are within the market average. So that's going to, we're not necessarily value investors, but we don't want to invest too much to own the stock either. But in the following video, I'm going to talk about how you can use these ratios to value a company by using the average price earnings of the industry and of its peers.